Hi, in this video, we are going to look at problem number 1, and problem number 1 will help us get an introduction into how this analysis has to be done. A firm has an all equity capital of 1 lakh ordinary shares of rupees 10 each. The firm is in need of rupees 3 lakhs to finance a new project and is considering three alternatives. 1. Issue of 30,000 equity shares of rupees 10 each. 2. Issue of 6% debentures worth rupees 3 lakhs. 3. Issue of 3,000 6% preference shares of rupees 100 each. The current earnings before interest and tax is rupees 5 lakhs. Regardless of the source of finance, the new project under consideration promises a return on money invested at 10%. The firm is subject to a tax rate of 40%. What is the current EPS of the company and what will be the impact on the EPS if each one of these alternatives is implemented? Right? So let us break down the question. You have a firm right now and this firm is in need of rupees 3 lakhs, and this 3 lakhs is for the purpose of an investment. Now I have three choices to raise finance. Let me call this as choice 1, choice 2 and choice 3. And choice 1 is where I raise finance in the form of equity shares, and choice 2 is where I raise finance in the form of debentures, which is basically debt finance, and choice 3 is where I raise finance in the form of preference shares. So I need 3 lakhs, but I have three choices of raising this 3 lakhs. Which choice am I supposed to pursue? And this is the question, and I need to be answering this question by doing this analysis called as EBIT to EPS analysis. In the question, what I am told is, regardless of the source of finance, the new project under consideration promises a return on money invested at 10%. So the meaning is, when I say return on money invested, here I refer to operating profits. So if I invest 3 lakhs, whatever source it is, so let me connect all the dots here. Whatever source it is, I am going to be getting 3 lakhs into 10%, which is 30,000. So this is the operating profits that this investment would give me. So this special investment I'm talking about here, the specific investment I'm talking here, this is going to give me an operating profit, is going to give me operating profits of 30,000 regardless of the choice of finance that I go in for. So this is what I was telling you in the previous video, in the introductory video, where whatever is the choice of financing, we are going to say that the EBIT is not going to change because it's only a matter of financing, and EBIT has to do only with business operations. So that's exactly what the question is also telling us in this regard. So 30,000 is going to be the EBIT I am going to get from this investment. But as of now, I have 5 lakhs of EBIT. So this project is just going, this investment is just going to be an add-on. So in each of the cases, currently I have 5 lakhs of EBIT, but after the investment is done, whether it is choice 1, choice 2 or choice 3, I'm going to have total EBIT of 5 lakhs 30,000. Existing 5 lakhs, that would still happen, and I would get new EBIT of 30,000. So together, after the investment, I'm going to have 5 lakh 30,000 of EBIT. But is the EPS going to be the same? Definitely not, because each choice has to do with one specific type of financing, and that's definitely going to have an impact on the EPS. Let us see how that's going to have an impact on the EPS, and that's what we are going to find out in this analysis. I'm going to have 4 columns here for comparison because the question is asking me the EPS for what's as the status quo EPS also, right? As of now, what is the EPS? That's also something that I need to look into. So I am going to call this as current. So this is only because the question asks me to find out the EPS now. Then let me have 3 columns for choice 1, choice 2 and then choice 3. Okay. Now The first point is going to be EBIT. Remember, this is EBIT to EPS analysis. As of now, the EBIT is 5 lakhs. And if it's going to be any of the three choices, that means the investment is going to happen and the EBIT is going to be 5,30,000. Old EBIT plus additional EBIT, I mean existing operating profits plus additional operating profits, 5,30,000. And from this, I'm going to be subtracting interest. So I'm going to go all the way up to EPS. So the first subtraction is going to be interest. And right now, the question tells me that the firm is an all equity firm. It has only equity capital, so no interest here. And if it's going to be choice one, again the financing is only going to be in the form of equity, so no question of interest. If it's going to be choice three, the financing is going to be in the form of preference shares, so no question of interest on debt. So interest is going to be there only in the case of choice two. And I'm going to raise finance in the form of 6% debentures. So my interest calculation is going to be 3 lakhs into 6%, which is going to give me 18,000. So this is the interest. So if I subtract that, I'm going to get EBT, earnings before tax. So that is going to be 5 lakhs for the in the current scenario. It's going to be 5,30,000 for choice 1. It is going to be 5,12,000 for choice 2, and it's going to be 5,30,000 for choice 3. From this EBT, I'm going to subtract tax. Tax is at the rate of 40%. This is told to me by the question. So as of now, the tax is going to be 2 lakhs, 40% and 5 lakhs. And for 5,30,000, the tax is going to be 5,30,000 into 0.4. That's going to give me 2,12,000. And when in choice 3, when the EBIT itself is 5,12,000, then if I apply 40% on that, that's going to be 2,04,800. And even for choice 3, it is going to be 2,12,000. This is the tax. So now I would get EAT, earnings after tax. So for in the current case, it's going to be 3 lakhs. As of now, it is 3 lakhs. And for choice 1 and for choice 3, it is 5,30,000 minus 2,12,000. That is going to be 3,18,000. And yeah, this is going to be the case even for choice 3. For choice 2, it is going to be 5,12,000 minus 2,04,800. That is 3,07,200. Earnings after tax minus preference dividend. Let me abbreviate it as PD, preference dividend. I'm going to be having preference dividend only in the third choice. As of now, it's all equity, no preference dividend. Choice 1 is again equity, no preference dividend. Choice 2 is again debt, no preference dividend. I'm going to have 6% preference shares in choice 3. So that's going to give me preference dividend of 18,000. So I will make the subtraction only for choice 3. So now I have PAES. When I say PAES, what I mean is profit available to equity shareholders. So right now it is 3 lakhs. Choice 1, it is going to be 3,18,000. Choice 2 is going to be 3,07,200. And choice 3 is going to be just 3 lakhs. Now I want to calculate EPS, so I have to divide this by number of equity shares. So as of now, I have 1 lakh shares. Now if I go for choice 1, I am going to issue extra 30,000 shares. So I will be having 1,30,000 shares. If I go for choice 2, the additional financing is going to happen only in the form of debentures. So no extra shares will be issued. Just whatever I have is going to be there with me. It's going to be 1 lakh. And same is the case with choice 3 as well. So only in choice 1, the number of shares is going to increase. So profit available to equity shareholders is called as earnings for the equity shareholders. If I divide that by number of shares, I get my earnings per share. So as of now, Currently it is 3 rupees, and when I go to choice 1, it is going to be 3,18,000 divided by 1,30,000. That is going to be 2.45 rupees, 2.45. Then in choice 2, 3,07,200 divided by 1 lakh, I have 3.072 rupees, 3.072. And choice 3 also, I have rupees 3 lakhs divided by 1 lakh, I have rupees 3. So now I have done an EBIT to EPS analysis. So if you see here, this is exactly how that analysis will look like. I started with EBIT and I came all the way to EPS. So we can see that a lot of things differed in every calculation, right? Among choice 1, 2 and 3, it looks like choice 2 is the best as of now because we have the highest EPS. So looking at EBIT to EPS analysis, I would say we would have to go with choice 2. If I go with choice 2, shareholders are going to get extra EPS compared to what they are getting right now. As of now, for every share that they hold, they have an earnings of only 3. Now they're going to have earnings of 3 and a little more than that. Even though we say that this is just a little more, not a lot more, just a little more than 3, but still, it's still more, right? Um, Arithmetically, it is still more than 3. So we will conclude that as per the EBIT to EPS analysis, choice 2 is the best. Now, if you analyze what has happened here, the conclusion that I would like to draw is, for some reason, let us say for some reason, I am not able to go for choice 2, right? For some reason, let's say I'm not able to go for choice 2, then if I still need to do this project, if I still need to make this investment, the next best choice I have is choice 3, where the EPS is not increasing, but the EPS at least remains the same. So how I would like to understand choice 3 is this way. The shareholders are not likely to gain anything by this additional investment, but they are also not losing anything by this additional investment because their EPS is protected. So by doing this extra investment, their EPS is protected. It does not increase, but it does not decrease also. Here again, there may be one question. The shareholders, a very logical question the shareholders could pose is, I mean, if I'm not going to get any increase in the earnings per share, why should the company do this investment? What is in it for the shareholders? That could be a question. But well, nothing at least bad happens here. So if I should do this investment for some reason and choice 2 is not available for me, choice 3 is the best. But I should never probably go in for choice 1 for the simple reason that if I pursue choice 1, the EPS decreases. The shareholders are getting right now rupees 3 for every 1 share as earnings. They're going to be getting only 2 rupees and 45 paise if it's going to be choice 1. So shareholders themselves would not like this company going in for this investment and raising finance all in the form of equity. So the order would be choice 2. If that's not possible, choice 3. If that's not possible, then probably let's not think about this investment at all, because if we do think about this investment without choice 2 and choice 3, then choice 1 is only going to reduce the earnings per share for shareholders. So in that case, we would probably, shareholders feel that they are better off if the investment is not done. This is how you should understand this EBIT to EPS analysis. Next point that I want to observe here is, now if you look at choice 2 and choice 3, it looks very similar. In choice 2 also you have 18,000 of a financing cost. In choice 3 also you have 18,000 of a financing cost. In choice 2, that financing cost is called interest. In choice 3, that financing cost is called as preference dividend. In both choices, you have the same number towards the financing cost. But still choice 2 looks better than choice 3. We should understand why. When you have the same 18,000, why should one choice look better than the other choice? The simple answer to this question is, if you observe our calculations, this is when I do an EBIT to EPS analysis, I'm just drafting a part of the income statement. From EBIT, I'm drafting the income statement to the other levels of profit. If I look at this income statement, 4 income statements here, and specifically choice 2 and choice 3, the placement of this 18,000 made all the difference. In choice 2, the 18,000 was placed here. In choice 3, the 18,000 was placed here. Though 18,000 is there, the placement of 18,000 was different. Now, why is the placement going to matter? It is going to matter because in one case, the cost was before calculating tax. In other case, the cost is after calculating tax. In other words, what has happened is, when it was interest, it was a tax deductible cost. But when it was preference dividend, it was not a tax deductible cost. So what happened is, in the second choice, if you see, the tax outflow to the government is only 2,04,800. I am able to have a lesser tax outflow because of debiting a cost called as interest to the extent of 18,000. I am having a cost in choice 3 also, but I am not having a reduced tax outflow. I am having a higher tax amount of 2,12,000. So for the same 18,000 of cost, the tax is lesser in choice 2. That is why it looks like I am having, that is the reason why this choice looks even more attractive and I'm having a higher EPS. For the same cost, I get a partial benefit in choice 2, I don't get that. This is for the main reason that interest is a tax deductible expenditure, preference dividend is not a tax deductible expenditure. So the tax savings, I will call this as tax savings. What do I mean by tax savings? Reduced outflow in tax compared to the other choice. In this choice, I have a lesser outflow. That's called as a savings and tax outflow. So I call this tax savings. And why did this tax savings happen? Because of interest. So the tax savings on interest came as a shield and made me feel protected even though I have a cost. And this in fact made this choice 2 even more attractive to choice 3. So the placement of this 18,000 was very, very important. Then, why does choice 1 look very bad? Why is it reducing the EPS even further? The answer is very simple to this also. If I look at the EBIT, when I move from what I am now to choice 1, basically from status quo to choice 1, if I move, I do get some additional operating profit. So that's a happy thing to feel about. But I should notice that there are more people coming to share my PAES now. So I have additional operating profits, but when it comes all the way down to PAES, profit available to equity shareholders, there are more number of people who are now sharing it. 1 lakh shares was sharing 3 lakhs, now 1 lakh 30 is sharing 3 lakh 18. So there is an increase in PAES I should feel happy about, but there is also an increase in the number of people who are sharing this. And here what has happened is the proportion has not been the same. For a small increase in the profit that is available to equity shareholders, larger increase is there in the people who are sharing it. For the small increase in the profit available to equity shareholders, larger increase is there in the people who are sharing it. So for every 1 share, if you see, the earnings comes down. So absolutely, if you look at the earnings as such for the shareholders, 3 lakhs becomes 3 lakhs 18. So in that front, it is good. But the number of people, that proportion increased way more than the increase in the PAES, I would say. So this is the reason why you find choice 1 to be very bad in this, or very not attractive in this. I mean, in fact, I can use the word bad itself, though it's an extreme word, I can use that word itself. Compared to the current situation, choice 1 is bad, definitely bad. This is the reason, right? So this is a good understanding of the EBIT to EPS analysis, and I'm concluding by saying that go ahead with choice 2. Okay. So in the next videos, we are going to look into the other problems for a lot more understanding of the same topic.